Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, and welcome back to another episode of the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal here at the SWU Group. Now, one of the biggest questions that most of my clients have been asking recently is, equities have done so well. Why don't we continue to pile into equities? You're making different recommendations now. We seem to be taking some risk off the table. Why is that, given the fact equities have done so well? So as per the title of today's podcast, we're going to talk about the ghosts of market past and the key question of whether or not we are in a bubble again. Now, we've seen over the last 1 to 2 years the continual theme of news headlines saying that we've hit another record high in markets. A handful of stocks, especially in the US, like Apple and NVIDIA, Meta, and Microsoft, are carrying most of the market gains. The headlines are shouting all about AI, cloud computing, and the digital revolution. But if you look closely and really closely, you'll see a pattern forming. And it looks eerily similar to some other market cycles we've seen before. So today we're going to unpack the Nifty 50, the dot-com boom, and we're also going to take some observations from what we're seeing Warren Buffett is doing about his exposure to the market, and also really when to quietly step away.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Now, if we consider one of the booms of the last half century or so, we saw the creation of what was called the Nifty 50. Now, for keen-eyed observers that look at equity markets, you might remember that the Nifty 50 also refers to the larger Indian equity benchmark called the Nifty 50, or the top 50 companies, but we are not talking about that today. We are talking back about the 1960s. Because during the late 1960s and early 1970s, investors were obsessed with what was then the Nifty 50, which was a group of blue chip US companies that were considered can't miss investments. And these at the time were household names. They included Johnson & Johnson, Coca-Cola, Polaroid, Kodak, Xerox, McDonald's, and Procter & Gamble. And investors believed that these companies were so dominant, so innovative, and so reliable that they could be bought at any price. And many did just that. The price to earnings ratios of 40, 50, even 60 times earnings weren't uncommon. For comparison, the long-term average PE for the S&P 500 is around 16. So you can see how extreme those PEs have gotten. And a quick recap for those who aren't familiar with PE, it is what is called the price to earnings ratio, which is a simple way of assessing whether or not a market or a company or a sector is relatively cheap or expensive. You're effectively taking the market value of the company, otherwise known as price, and dividing by its latest profitability. And therefore you get a multiple. Broadly speaking, if that multiple or that number is higher, that reflects that the market is broadly more expensive. So we had these companies trading, in the late 1960s at 40, 50, 60 times. But then inflation hit, interest rates rose, and the economic conditions had tightened. Okay, think about the post-COVID era where inflation was out of control, RBA increased rates 13 times straight. What happened? Valuations collapsed, even if the companies themselves actually kept growing. For example, Coca-Cola actually went down 40% between 1973 and 1980, despite its top-line sales continue to grow. We had Polaroid, if you remember, for those that are old enough, those disposable cameras. That company was once considered the apple of its time, fell over 90% and eventually collapsed. We then saw other companies like Xerox, which dominated the copier market, ultimately lost out to Japanese competitors like Canon, and Digital Equipment Corp, a leader in computing, got out-innovated by IBM and other groups. Now, the key lesson you need to take out of all of this as an investor is that on one hand, you can be right about the business, right? Top-line sales growth is good, profit growth is good. The theme, the structural change in the economy leads to stronger structural growth of the company. But at the same time, you can be very wrong about price. And if you consider today's titans, they can bring some echoes from the past, right? If we look at the modern day Nifty 5, that would then include Apple, which on any given day is probably the world's most valuable company with over $3 trillion market value at its peak. You've got NVIDIA, which is the AI chip leader, up over 200% in a single year. You've got Microsoft, which is the cloud and enterprise software powerhouse. You've then got Meta, which is the social media giant that is behind Facebook and Instagram and now owns WhatsApp. And then you've got Alphabet, which is Google's parent company, which is still printing money via search, but is now under pressure from AI rivals. Now, the issue is that just these 5 stocks make up 35% of the S&P 500's value. And remember that you have a situation where 500 companies make up the index and 5 already make up 35%. That is an issue, and it's the highest concentration we've seen in decades. And if we consider their valuations, I mean, NVIDIA trades at over 35 times forward sales. You've got Tesla, which is another favorite stock of many retail punters, was once at over 1,000 times earnings at its peak. And then you've got Amazon, which trades at over 60 times forward earnings. Now, you could sit there and argue, now these are different, these companies are changing the world. And the reality is that they probably are. But that's what they also said about Polaroid and Xerox and Kodak during the Nifty 50s in the late 60s. And here's an important fact or a real life case study. We all know about Cisco Systems, right? They are one of the most powerful companies that do IT infrastructure. And in 1999, it was one of the most valuable companies on earth. Its routers powered the internet boom, and Cisco's revenue kept growing after the dot-com crash. But its stock still took 16 years to return to its prior peak. So just like the Nifty 50, many of these companies kept performing well, but their valuations simply couldn't hold up. Which is why you can always buy a good quality company, but you just bought it at the wrong price. If we then consider Warren Buffett's stance on this, he has an incredible secret weapon, which most investors simply have no ability to do, which is walk away. Warren Buffett is probably the world's best-known ultimate long-term investor. And in 1969, while the go-go market was booming, Buffett shocked everyone by shutting down his investment partnership. Why? Because he believed he couldn't find anything to buy that made sense. He saw the bubble forming. And even though markets rallied well into 1973 and then 74, in 74, everything crashed. And Buffett, he avoided the worst of it. And same again in the late 90s. Buffett was actually mocked during the tech boom when people said he didn't get it, he's too old school, he doesn't understand tech. He stayed out of the dot-com mania, missed the highs, but also missed the 80% drawdowns. In 2008, during the GFC, he had cash, and he used it to buy who? Goldman Sachs and General Electric on fire sale prices. Great companies acquired at a great price. Where do we sit today? Berkshire Hathaway, which is Warren Buffett's investment company, is sitting on over 150 billion US dollars in cash. Why? Because Warren Buffett ain't chasing, he's watching, he's waiting, like he always has. Probably the most famous Buffett quote, and something to remember, is that be fearful when others are greedy, and greedy when others are fearful. The underrated Buffett trait that investors need to learn from in this case is that he's not just a buyer, he is the ultimate risk manager. While staying on the Buffett theme, there is something that many years ago, some fund managers in the US came with something called the Buffett Indicator. What's this? It's sort of like a market signal situation. And what the Buffett Indicator is that it's the ratio of total US stock market value compared to US GDP, or gross domestic product. Think of it like a national price to sales ratio, right? It gives you an idea of how frothy, or on the other hand, how cheap equity markets are. In 2000, at the peak of the dot-com, it hit 140%. In 2008, before the crash, otherwise known as the GFC, it was around 110%. Today, it's over 180%. It is flashing clear red. Now, everyone needs to remember, though, that this doesn't mean a crash is imminent. It just means the market is pricing in perfection. And when that happens, expectations are fragile. It's what we call margin of safety. If you know that you've bought a stock really cheap, and let's say in the incoming period, there is a market correction, you know that because of the fact that you bought really cheap, it was really good value, the value itself wouldn't fall that much, even in a crisis. Like if you buy a really cheap car and you know you bought it for 20% under what was the market value because your uncle sold it to you, you know that longer term, it's probably a good investment that won't depreciate much, right? This is what we call the margin of safety. All you need is a single earnings miss, a rate hike, a geopolitical shock, or anything else that can trigger a correction. Let's look at 2022. Remember, inflation was high, US rates went from 0 to 5.5%. What did we see? Meta dropped 70% in its share price in 9 months after disappointing on a single guidance. Netflix halved in value after losing a little bit of its subscribers. And the ARK Innovation Fund ETF was full of high growth names, fell over 70%. When multiples are high, gravity hits hard. You can think it's based on the same theory of anything that's gone up must come down. But then the question is this time different? You always hear this term being bandied around, right? This time is different. Like, we can talk about, Jonathan, you can talk about the Nifty 50, you can talk about the tech wreck, but this time it's different. And maybe it is. AI is definitely real, cloud computing is powerful, and semiconductors are the new oil. But the same people said in 1999 that the internet changes everything, which it did. Old rules don't apply, which wasn't true. And clicks over profits, i.e. people clicking on things, and that's why search became so popular. That was all true, just the valuation was wrong. So this sounds familiar. And if you think about things in hindsight, the internet did change everything, but not every company survived. Pets.com didn't make it, AOL, otherwise known as America Online, they faded away, and Yahoo got left behind. And it wasn't until 2006, which is 6 years later after the boom, that Amazon got back to its .com era peak as well. So yes, this time could be different, but if valuations are stretched and you're overexposed, it might not matter. Now, today's podcast is really a precursor to an interview that I'm going to have with a good mate, Anthony Doyle, who is the chief investment strategist over at Pinnacle Investment Management. And I've invited him to come over and talk about more case studies about what we learn about markets of past, and what do investors need to remember as part of their investing psychology. So that one will come soon. But finally, to wrap things up, what are the practical takeaways today that an investor can actually do when reevaluating their portfolio? Number one, check your concentration, right? Are you holding too much of one theme? Are you holding everything in AI or everything in US tech or everything in gold if you're holding the bear case at the moment equities? You might consider rebalancing. Now, obviously, speak to your financial advisor as to what your beliefs are and whether it's aligned with theirs, but because they will have their view as well. Number two, trim. Don't time the trim, right? You don't need to sell everything, but maybe shave off some profit from what you think is overheated positions that you've made a lot of money in already. Number three, diversify. You might consider looking beyond the US, Asia, Europe. Even emerging markets could offer better value at this point in the cycle. Number four, always hold cash, right? I always encourage my clients, there is benefit in holding cash. Yes, it's not generating you any returns, but it gives you what we call dry powder to then activate when markets become flustered and people lose faith and valuations come off the boil. That gives you opportunity to go up. And then finally, avoid FOMO. If you've seen a stock that's gone up 300% in 12 months, ask yourself, am I chasing the story or am I chasing some real numbers? Because that will make the true difference between whether or not you're a long-term investor or you just want to trade a particular theme. A quick stat on this, stocks that are trading above 10 times revenue usually see their multiples fall by 60% within 5 years. That's based on the 30-year S&P 500 study. So we've covered a lot in today's podcast, from the rise and fall of the Nifty 50 to today's tech giants and what Warren Buffett's doing about it, especially when he takes a stance of walking away. Remember that great companies are not always great investments. History might not repeat, but it rhymes. Valuation still matters, and you don't have to sell everything. You don't have to panic. But you do need to take a breath, maybe trim some of the froth, and remember that Buffett's greatest investment wasn't a stock. His greatest investment was this discipline, knowing when to be in and when to take the foot off the pedal. As always, happy to take feedback. You can find me on all the socials, or you can email me at jonathan.wu@simonwu.com.au on topics that you might be interested in listening to. And remember to listen to the disclaimer at the end of this podcast to note that what I've said today is not personal financial advice and just for entertainment purposes only. And with that, I hope everyone enjoys the rest of the week, and I'll see you in the next episode. See ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.